Welcome to the Principles Experience. This channel is designed to give you financial content in the areas of business, finance, and investing, while bringing you stories of the mindset of entrepreneurs and their tips on building the business. Sit back and learn on how you can develop your financial wisdom and create a blueprint for financial freedom. What's going on, YouTube? Welcome back to another episode of the Principles Experience. My name is Kevin Jenkins, and I have a great show outlined for you all today. And today I want to go specifically into you knowing your taxes between earned, portfolio, and passive income. And I know I'm also going to touch on capital gains and capital losses and the tax implications for either of those situations. And I know within my 11th episode, if you haven't heard that, I will go listen to it. I talked a little bit briefly about capital gains and talked about how it's determined with an investment. And if you haven't heard it, I will go back and listen to that one. And that one will give you a little bit more insight on the concepts that I'm going to talk about throughout this episode. Now, before I move forward, I wanted to go ahead and say a disclaimer. I know I've said this in previous episodes, but keep in mind that I'm not a registered financial advisor. My content is designed for informational and educational purposes only. Please consult with an advisor or a brokerage firm when making an informed financial decision. The information that I give you, please do your own research and become aware of the risks when making an informed financial decision. You must understand your own risk tolerance, your time horizon, and be comfortable with making a specific investment decision. So when it comes to the taxation on capital gains and capital losses, the IRS, they divide your income into three areas, three categories. And the first one is earned income. The second one is portfolio income, and the third is passive income. Now, with earned income, that would be simply the salary or the wages you receive from your occupation. If you're a business owner and you have your own earned income that you make throughout the year, that would be classified as all income. And all ordinary and necessary expenses that are required to earn that income, they are term losses, and they actually can be deductible towards your earned income, which is very great to know. So the necessary business expenses that's associated with you earning your income, such as auto expenses or business entertainment, all of that can be deducted against your earned income when you file your taxes at the end of the year. So let's say, for example, you have an individual, he's an outside sales representative, and most of his job, he's traveling from business in business to be able to sell his products or services. His travel mileage that he accumulates throughout the year, he can take that expense and he can deduct it against his earned income. So that's just one example. And with earned income, the maximum tax rate is 37%. Now, the next that I wanted to dive into is portfolio income, which is one of my favorites. I know for me, I have portfolio income with my investment portfolio, and pretty much portfolio income is divided into investment income and or loss, and capital gains and or your loss. Now, investment income is simply the dividends that you receive from a stock or interest payments that you receive from debt investments or debt instruments. So if your money is in a bond, that would be a debt instrument. Now, the maximum tax rate on cash dividends received from holdings of a corporate stock, which are common and preferred, is reduced to 15% instead of being taxed at the ordinary income rates of 37%. Now, if an individual is in a high tax bracket, their tax rate is increased to 20%. Now, I wanted to go into capital gains and capital losses. It's so important to know that this information when it comes to investing, because you will always want to look at how you can be able to save more money long term and keep as much for yourself and give as less as you can to the government. Now, capital gains, they consist of the gains realized from the sale of your assets. Another investing term, you will hear unrealized gains, which are the gains that are accumulated with inside your portfolio And they're called unrealized because the money has not been pulled out of your portfolio. It's when the money is pulled from your portfolio when you're going to get taxed. Now, the capital gains on the sale of all assets, they are the different investments that are included in that are stocks, mutual funds, options, bonds, real estate, and artwork. And capital losses on the sale of your assets are only deductible to the extent of your capital gains. Now, the maximum net capital loss deduction is $3,000 per year. Very important to know. The tax code, they give benefits in that your capital gains, they can be utilized to reduce your taxable capital gains to zero. And you also can use it up to the $3,000 that can be deducted throughout the year. And any unused losses, they're carried into the next year. And then it can be offset against any future investment income that you have. So just to give you a concrete example, so this logically makes sense. Let's say, for instance, you have an investor. They have a capital gains for the year of 2020 of $10,000, but their capital losses for the year are at $14,000. Their net capital loss for the year is $4,000. But keep in mind, $3,000 of that can be deducted where you don't have to pay that amount back. So $1,000 is going to be the total loss. The unused loss is going to be carried into the following year. So it's very important to know that information, especially if you're an investor and you do have some losses throughout the year and you want to try to minimize those losses as much as possible. Definitely take advantage of the $3,000 net capital loss deduction that is available to all investors every year. And the biggest emphasis that I wanted to get across to you all is that whether with any capital gain or loss with an investment, the gain or the loss is either short-term or long-term. And the tax implications, they're different for each. So let's say you invested in a company and you sold the position and realized the gain throughout the year, within 12 months. The maximum tax rate is going to be at 37%. Now, if you're an investor and you sold a position within more than a year and a day, that gets reduced all the way down to 15 or 20%. And 20% is usually only applied to individuals that are in the highest tax bracket. Now, the tax implication is the same if you have a capital loss on an investment as well. And I would definitely say for people out there that are active traders, hold your investment for longer than a year because one, the capital gains tax is much lower, and that's less the money that the government has to take out of your pocket. And for me, and I know for you, you want to keep as much as you can. So definitely hold the investment for longer than a year. And then when you file your taxes, you often will have to fill out a 1099 DIV form. DIV is a short acronym for dividends. And pretty much that's the dividends that you receive from your investments throughout the year. You also may have to fill out a 1099 INT form, which is interest, the interest income that you receive from any payments, whether it's with a bond, anything that's a debt instrument. Now, lastly, I want to talk about passive income. Now, passive income, this is defined as the income received from real estate investments and limited partnerships, limited partnership interests. Now, limited partnerships are usually the structure for any tax shelter investment. I know a lot of times with an LLC, some of those can be structured. And the LLC is a limited liability company. Those can be structured with limited partnerships. And one thing about limited partnerships is that they're structured as a tax shelter investment because they offer flow-through taxation. So the expenses associated with managing real estate or limited partnerships, they are deductible against any of the passive income. Now, keep in mind, your passive losses can only be offset against your passive income, which is your tax shelter income. Your earned income or your portfolio income, it can't be offset by passive income. So that's one thing to keep in mind. And that pretty much wraps it up for this episode. I definitely hope you all got some more insight on just analyzing your taxes with earned, portfolio, and passive income. It's important to know this information because, some of us don't understand the tax implications of each of these three areas. And I think that if you know how the IRS divides it into these three categories, it allows you to be able to have more insight when you're making your financial decisions when it comes to your investments. And knowing the different taxes also shows why you should be a long-term investor. And all of this is very important to me because I know for myself, growing up in Michigan, I never really had anyone that talked to me about things like this, taxes when it comes to passive income, when it comes to portfolio income, and just being able to manage my money a lot more effectively. So let's continue to make financial literacy an open discussion with our family and friends. As always, if you all can like, subscribe, and share this video, I would greatly appreciate it. I'm also going to put my link tree in the notes because I'll have my Instagram on there. I drop financial content on a weekly basis. And also with my podcast, it's on all audio platforms, Apple Podcasts, Spotify, Google Podcasts. You'll be able to also listen to this information as well. So I want to tell you all, thank you so much for tuning in to the Principles Experience, and take care.